In today's video, we're going to fix this income statement and actually put together a proper statement of comprehensive income. So what we're looking at is an income statement and also a statement of retained earnings. And some of the information in here isn't correct. So when we do the comprehensive income statement, this is only for IFRS. Just because under our ASPE standards, there's no concept of comprehensive income, so it would just be a regular income statement. So let's get started. So I'll properly title my statement of comprehensive income. So I'll start with On Time Clock Company, Inc. And what I'll do is I'll just make this a little bit bigger. So we have On Time Clock Company, Inc. And then I'll call this a statement of comprehensive income. And this is for the year ended December 31st, 2020. So it looks like this is for the full fiscal year. Now, when I'm putting together the income statement, I'm going to use the multiple step approach. So that's the approach where you categorize everything. You've also learned about the single step approach where we separate all revenues and then total them, and then separate all expenses and total them. But everything that we want to do is the multiple step income statement approach. So I'll start with my sales revenue. And I'm okay with that 358,675 right there. So I'm going to go ahead and just type that amount in. So 358,675. So that was done properly. Same with the cost of goods sold. Now what I like to do is just put brackets around any of my expenses. That just makes it a little bit easier to total everything when I'm actually in Excel. So the gross profit is 160,563, and that's just the 358,675 minus the 198,112. So there we go. So now the next step is I'm going to list my operating expenses. If I can spell that. Okay, so when I do that, I'll want to total up all of my selling expenses and put them together. And in this case, they're 41,850. And then I want to total up all of my administrative expenses. And those are 32,142. So I'll just add those together. So I'm just summing those two together. And that gives me 73,992. So if I take the 160,563 and I subtract the 73,992, that's going to give me operating income before income taxes, or sometimes you've heard this referred to as EBIT, of 86,571. So the next part is to deal with any of our unusual items. So these are our other revenues and gains, and then also our other losses and expenses. And so these usually arise not specifically from our business operations. So it's not derived from selling our product. They're just other increases that occur because we're changing the values of our net assets. So in this case, we'll start with other revenues and gains. And when I look at the other revenues and gains that they have on the income statement already, I'll just highlight this in a different color. I do agree with their dividend revenue. So basically, we have shares in another company, and that company paid us out dividends. So we recorded that as our revenue. So I'll put that down as $40,000. Now what's really interesting is whoever put this statement of changes in equity together did it wrong. So if I look here, I see a gain on disposal of long-term investments. That should actually go through the income statement. So whenever we own shares and whenever we dispose of them, what we'll need to do is record the gain or loss on our income statement. And we'll actually be studying investments in depth in a few chapters. So for now, we'll just go with that. So gain on disposal of long-term investments. And that was $31,400. Now I didn't see any other revenues or gains, so I'll go ahead and subtotal that up. So now what I'll want to do is just do another subtotal. So I'm just going to add together my operating income and my other revenues and gains. And that comes to 157,971. Now the next step is to look at any other expenses and losses. So in this case, let's just scroll over here again. It's really interesting to see that this loss on expropriation, again, they put that through the statement of changes, but that should go through the income statement. So I'm going to go ahead and reallocate that. So just remember, these two statements are from somebody who tried their best to put it together. They weren't necessarily an accountant. And so what we're doing is we're just fixing it. So that's the 13,000. Now I didn't see any other losses, so I'll just go ahead and subtotal this. So I'll take the 157 and subtract the 13,000, and that gives me my income before income taxes. Okay, so now if I just, before I calculate my income taxes, if I just look through the rest of this statement of changes in equity, you'll notice that there's a correction of mathematical error right here, and that's net of tax. So that actually does belong in there, because when you do your statement of changes, you remember that you have opening retained earnings or opening equity, you add in your net income, you subtract out your dividends. But also, if you have to adjust for any prior period adjustments or material corrections or errors, it would go through this statement net of tax, and it would adjust against the beginning retained earnings amount, because that's what we're actually fixing. So that statement is now fine. So let's figure out how to calculate this income tax. So I'm just looking in this question to see if they gave me an income tax number. Okay, and I don't think they did, but it's okay. What I can do is if I take my income tax expense and if I divide that by my income before income taxes, that should give me a percentage. Let's just check what that percentage is. So that's 35%. So I can assume that my income tax rate that we used is 35%. So because I don't have any better information to rely on, I'm just going to use that tax rate. So if I go over here, then I'm going to say my income tax expense, and maybe I'll just put 35% here just to remind myself that that's what I did. So if you take 144,971 and times it by 35%, you get 50,740. And so now this is my net income, or this is also known as earnings after tax. So I'm just adding my 144,971 minus my 50740 to get 94231. Now normally we would stop here. So if this was ASPE, then that would be the end of that. But the problem is this is a publicly traded company, and we also have comprehensive income. And comprehensive income occurs through a few different types of transactions that happen because we change the value on the balance sheet for some of our net assets. So sometimes we actually change them up or down to fair market value. So in these cases, when we don't actually want that change to go through the income statement because it might cause a lot of volatility, what we do is we put it into this comprehensive income account. So all of this stuff closes into retained earnings, but now anything I list below this line is actually going to fold into accumulated comprehensive income on the balance sheet. So that's why we always disclose it separately. So it's a bit of a guessing game right now, just because you don't know what specific transactions go into comprehensive income. You will learn about a few of them throughout intermediate accounting and intermediate accounting 2. But for now, a pretty good indicator is if it says OCI, then we can feel pretty confident just putting it in there. So in this case, you'll notice the only one that I didn't pick up on this income statement was this amount here, this unrealized gain on fair value through OCI equity investments, 36,000. So that's what I'm going to put into accumulated OCI. So unrealized gain on fair value through OCI investments. Now what we do is we always put this net of tax, and the tax, let's see here. Well, if this is 36,000, we'll just have to do a side calculation here. So if this is 36,000 and I apply the tax rate of 35%, that will give me 36,000 times 0.35. So that'll give me 12,600. So that's the tax on that. So now when I put this through on my comprehensive income statement, so I'll just say net of tax 12,600, then what I'll do is I'll take that 36,000 and then minus your 12,600. So net of tax is 23,400. So now my comprehensive income is the net income plus or minus what other transactions are going to go through comprehensive income. So comprehensive income is 117,631. So a lot of companies will either combine their regular income statement with their comprehensive income statement, and some companies may choose to disclose them on two separate statements. So they might do their net income statement and then they'll do their comprehensive income statement. So it's just really up to each individual company how they want to disclose that. And I should probably just put dollar signs on here to make it look nice. And that would be it. Okay, so the only amendment that I would make in here is that if we did have discontinued operations, they would show up, right after net income. Then you would do your discontinued operations, and then you would do your items going into comprehensive income. But other than that, most of your comprehensive income statements should look just like this.